Open the Federal Reserve's H8 report. Look at line 34. While the media was hypnotized by politics and the S&P 500 hitting meaningless new highs, the biggest, smartest transfer of wealth in modern banking history just executed in plain sight. $940 billion evaporated from the accounts of America as small and mid-sized banks in just 90 days. This wasn't a chaotic bank run. There were no lines out the door. This was a silent, clinical, organized retreat by the institutions and clients who read the fine print. And the account you use every single day could be the next source of fuel for this quiet fire. The official data is undeniable. From the week ending October 4th, 2023 to the week ending January 3rd, 2024. Other domestic banks, which is the Fed's category for every bank that isn't a global titan, saw their deposits collapse from $5.42 trillion to $4.48 trillion. Circle that number. $940 billion gone. Zoom in on the line. It's not a blip. It's a controlled 3-month hemorrhage. Let's be brutally clear. This money did not vanish. It moved. It was electronically transferred out of vulnerable regional banks and into 3 destinations. 1, government money market funds now paying over 5%. 2, direct purchases of Treasury bills. And 3, the fortress balance sheets of the 2 big-to-fail megabanks. The people who moved it are now earning a 50x higher yield. If your savings are still sitting in one of the banks that lost this $940 billion, you are likely earning 0.1% interest. You are not just missing out, you're subsidizing a slow-motion institutional failure with your own stagnant cash. This is the elite knowledge gap in its purest form. The institutions knew the 2023 crisis never ended, it just changed form. Retail was told the system was fixed. Now, you face a triple trigger. The FOMO of watching smart money act, the distrust of a media that slept through it, and the cold fear that your bank name might be on the next unreported outflow list. But to understand why this 940B exodus is a 5-alarm fire, you need to see what it's funding on the other side. A $2 trillion weapon being built by the Fed itself. Let me show you the chart. It will show you the aggregate number. Total banking system deposits are stable, they'll say. That is the consensus lie. The truth is, in the isolation, look at the screenshot from the Fed's H8 report. Do not look at the all commercial banks line. Zoom in, isolate the critical vulnerable segment, other domestic banks. This is your local and regional banking system. Now, circle the quarterly change column, $940 billion. The total system number is a magician's trick, using inflows to the megabanks to hide the catastrophic bleed from everyone else. Now, highlight the rate of change. Do the math. That's over $10.4 billion moving out every single business day for an entire quarter. Not in a panic, in a steady, deliberate walk. This is the anomaly that proves the crisis never ended. The March 2023 event was the heart attack. And what you're looking at now is the patient hooked to a silent, steady life support bleed, with the public told they've been discharged healthy. The coverage gap is the proof of suppression. Do this now. Google News Search. Small bank deposit outflows Q4 2023. Your results? A handful of deep finance blogs and maybe one Bloomberg article buried behind a paywall. Now search SVB collapse March 2023. You'll get over 50,000 headlines from every major outlet. The media's narrative is crisis over. The data's reality is crisis institutionalized. The silent run gets no coverage because it doesn't serve the all-clear signal that keeps the public calm and the markets complacent. So who is moving this money and where's it going? The data gives us 2 forensic signals that reveal the entire insider game. Signal 1 is the source. It's primarily uninsured, institutional money, the smart money, fleeing first. Signal 2 is the destination. It's flooding into funds that give direct sovereign exposure to the one entity the insiders believe won't fail, the U.S. Treasury itself. They aren't just leaving weak banks, they are front-running the Fed's own next emergency playbook. Let me show you the $2 trillion facility where this money is pooling, and why its creation is the most bearish signal for Main Street banks you will ever see. History's most dangerous financial collapses never start with the public. They start in the plumbing. The $940 billion silent run has an exact deadly precedent, the 2007-2008 wholesale funding run. While Main Street was still bullish, the institutional elite were already evacuating. Let's align the parallels. The silent signal, 2007. The TED spread, the gap between what banks charge each other for loans and the risk-free Treasury rate, spiked violently. This was the insider's EKG, showing collapsing trust months before Lehman fell. 2023 to 24. The silent signal is the Federal Home Loan Bank, FHLB, advance surge. Regional banks have borrowed nearly $1 trillion from this obscure government lender since March 2023. This is not growth capital. It's an emergency liquidity tap, a direct signal they are hemorrhaging the cheap deposits that are the $940 billion we just saw flee. The first movers, in both crises, the first to run were not retail depositors. They were sophisticated corporations, pension funds, and institutional cash managers, the smart money that reads balance sheets, not headlines. The canary. The crisis is never centered on the giants first. It targets the weak link. In 2007, it was Bear Stearns and Lehman, not Goldman Sachs. Today, it's the other domestic banks category, not JP Morgan. The initial dismissal, 2007, Fed chair. Ben Bernanke infamously stated subprime fallout was likely to be contained. 2024, regulators and bank CEOs consistently proclaim the system is sound and resilient and well capitalized. The language of containment is identical. The $940 billion didn't have a mind of its own. It was moved by a ruthless, automated logic that separates two types of money in the system: hot money and sticky money. You need to know which one yours is. The $940 billion was almost entirely hot money. These are uninsured institutional deposits, corporate treasury cash, and algorithmic sweeps from large investors. This money has one mission: chase absolute safety and the highest overnight yield. It has no loyalty. It moves at the speed of light with a keystroke. It is the first to flee at the faintest whiff of risk or the sight of a better rate elsewhere. Your money, the cash in your checking and savings account, is sticky money. It's slower. It's tied to your life. Your direct deposits, your bill pays, your mental friction of switching banks. You are the last to know and the last to move. Here's the analogy. Picture a crowded theater. The hot money is the fire safety expert sitting in the back. He smells smoke you can't. He gets up and leaves silently, without shouting, not wanting to cause a panic that blocks his own exit. The sticky money is the family up front, engrossed in the movie. By the time they see actual flames, the expert is long gone, and the exits are jammed with everyone else who waited. Now, look at the amplification channel. Money market funds. They are the vacuum cleaner. This chart is undeniable. On the left, track the $940 billion outflow line from small banks. On the right, track the inflow into government money market fund assets. They are perfect mirror images. As money fled banks, it flooded into these funds, which then lent it right back to the government by buying Treasury bills. The money left the risky part of the private system and became a direct loan to the state. The experts confirm this. A recent Crane data report on money markets noted the historic inflows were primarily from institutional clients repositioning out of bank deposits. A portfolio manager from a top fund put it bluntly, "We are seeing a once-in-a-generation shift out of bank balance sheets." The hot money isn't just leaving. It's rehoming itself in the shadow banking system, where it can earn more and flee even faster next time. But this massive shift has created a $2.4 trillion problem for the Fed itself, forcing them into a corner where they must choose between saving banks and containing inflation. Their next move will decide everything. Let me show you the trap they're in. This silent run isn't Wall Street gossip. It's a financial gravity shift, and you're already feeling its pull in 4 distinct escalating layers. You must see where you are in this sequence. Level 1, the personal yield trap. Your bank is offering 0.1% APY on your savings for a reason. It is desperate to keep the sticky money it has left because the hot money is gone. It cannot afford to pay you a competitive rate. By keeping your cash there, you are voluntarily accepting a massive complacency tax. You are losing purchasing power to inflation daily, while the $940 billion that fled is now earning over 5% in government money markets. Your inaction is a direct, quantifiable transfer from your wallet to your bank's failing balance sheet. Level 2, your bank's silent decline. As deposits vanish, your bank faces a brutal choice: shrink and become irrelevant, or take on risk to keep profits up. It will likely do both. It will cut services, close branches, reduce hours, increase fees, monthly maintenance, ATM charges, and may start chasing riskier loan opportunities to boost margins. The bank you trust becomes a more desperate, less customer-friendly, and fundamentally weaker institution. Your experience degrades in direct correlation with its balance sheet. Level 3, the contagion freeze. As weak banks are forced into mergers or FDIC resolutions, your insured deposits are safe, but your access is not. History shows that during a bank failure, accounts can be frozen for days or even weeks while the FDIC unwinds the mess. If your emergency fund, your business operating account, or your down payment is trapped during that freeze, a systemic event becomes a personal catastrophe. Your money is a line in a database, and that database can be paused. Level 4, the Main Street credit crunch. This is the terminal stage. Hollowed out banks stop lending to local businesses, the restaurants, contractors, and shops in your community. Small business loans dry up, lines of credit are cut, job creation halts. The financial decay metastasizes into your local economy. The silent bank run evolves into a loud Main Street recession. It stops being about percentages and starts being about paychecks and boarded up storefronts. Here is your 60-second audit. Go to your bank's website right now. Find the APY for your savings account. Write it down. Now, open a new tab and Google Vanguard Federal Money Market Fund, VMFXX, 7-day yield. See the difference? That gap, often 4 to 5%, is the exact price of not following the smart money. It's the dollar cost of the information gap. But this gap is forcing the Federal Reserve into an impossible choice that will define the next year. To understand your final risk, you need to see the $2.4 trillion facility they're about to drain dry. The silent run isn't linear. It's accelerating. Look at the slope of the H8 data line. The weekly outflow didn't just continue through December, it increased. The pressure is building exponentially, not receding. Each billion that leaves makes the remaining bank balance sheet shakier, which prompts the next billion to leave faster. This is a classic financial death spiral, and we are in its middle stages. The catalysts that will turn this silent run into a loud crisis are already on the calendar. The next Fed meeting. If the Fed even hints at cutting rates later this year, it will trigger a perverse finale. Lower rates would reduce the yield on money market funds, but not enough to drive money back to weak banks. Instead, it would be a signal that the economy is cracking, prompting a final wave of hot money to flee banks for the safety of treasuries before the door slams shut. Q1, 2024 bank earnings, April. This is the moment of forced confession. Bank CEOs will have to explain these catastrophic deposit trends on public earnings calls. Their guidance singum for the future will be a masterclass in euphemisms, disciplined liability management, optimizing our deposit base. Translation, we are in survival mode. The stock price of regional banks will be the public report card. The 2024-2025 commercial real estate maturity wall. This is the vicious cycle. These weakened banks lent heavily to office buildings and malls. Those loans are coming due. With a decimated deposit base, these banks cannot renew the loans. They will either have to take massive losses or foreclose, which craters their capital further, triggering more deposit flight. Watch for this threshold point. When a major regional bank officially announces a strategic review or puts itself up for sale, that is the white flag. It means the silent run has won and the institution is capitulating. That announcement will be the starter's pistol for the next wave of panic. This defines your critical window. The time to move your cash calmly to reposition from sticky to smart is right now in the relative quiet. The window slams shut the moment the next credit event hits, a major loan default, a bank failure, and turns the silent run into a loud public panic. At that point, the weakest institutions will impose withdrawal gates or temporary processing delays. Your liquidity will become their collateral. Your advantage is acting while they still process requests normally. The final piece is understanding the Fed's $2.4 trillion dilemma that makes this outcome almost inevitable. Let's break it down. In a silent run, the goal is not to be the last one holding a claim on a weakening bank. The asymmetric move is to act on the information gap before it closes. Here is the tiered strategy, moving from defensive to tactical. Category 1. Follow the smart money, liquidity preservation. This is non-negotiable for your core cash. Vehicle 1, Treasury-only money market funds, e.g. VUSXX, SNSXX. Now this is the exact destination of the institutional $940 billion. These funds hold 100% U.S. Treasury bills and repurchase agreements. You get direct government exposure, near-perfect safety, and currently a 5% plus yield. You are essentially becoming a mini central bank, lending directly to the U.S. government and bypassing the broken bank intermediary. Vehicle 2, direct Treasury bills via Treasury Direct, Governor. This is the purest play. You buy T-bills directly at auction, hold them to maturity, and your money is literally a line item on the U.S. Treasury's balance sheet. You have fully exited the commercial banking system for that capital. You are the bank. Category 2, the tactical short side, for sophisticated risk capital only. Asset 1, regional bank ETF, KBE. Put options. This is a hedge or speculative bet on the continuation of the silent run. The $940 billion outflow is a direct mortal blow to regional banks' net interest margins, their profit engine. This pressure will crush earnings. Warning. This is for risk capital only. Options are volatile, time-sensitive, and you can lose 100% of your premium. This is not for savings. Category 3, what to abandon immediately. Action. 1. Exit savings accounts at high Texas ratio banks. The Texas ratio is a simple public metric, total troubled assets, TOS capital plus loan loss reserves. A ratio above 50% signals severe credit stress. Google your bank's name and post Texas ratio. If it's high, move your money. Now. Action 2. Do not chase high. CD rates at troubled banks. A bank offering a CD rate 2% above the national average is not being generous. It's desperate for funding. You are not earning yield. You are selling insurance on a risky balance sheet. The extra interest is your risk premium. The allocation mandate, your emergency fund, the 3 to 6 months of expenses that is your financial lifeline, should be parked in Vehicle 1, not in a checking or savings account at a bank bleeding deposits. This is not market speculation. This is the prudent preservation of your most critical capital, aligning yourself with the entities that have the best information. But to see why this move is urgent, you must understand the Fed's final tool, the $2.4 trillion reverse repo facility. That's about to hit zero and remove the last private market buffer for these failing banks. You've now seen a $940 billion shift that redefines American banking. So why is your newsfeed filled with everything but this? The blackout is structural, psychological, and intentional. The structural conflict of interest. Who are the largest advertisers on CNBC, Bloomberg TV, and mainstream financial news sites? The major banks and asset managers. These institutions have a multi-billion-dollar incentive to project stability. A relentless focus on a silent, systemic bleed that makes their entire sector look fragile is terrible for business. The media's revenue model depends on not rocking the boat of its wealthiest passengers. The psychological comfort of aggregates. Every time you hear total bank deposits are stable, you're being misled by an average. It's like reporting the average temperature in a room where one person is on fire and another is in a freezer. Technically correct, functionally useless, and designed to soothe. The brutal redistribution, the $940 billion hemorrhage from the weak and the corresponding swell at the strong, is the only story that matters, and it is deliberately buried within the aggregate. The institutional reassurance mandate. The Fed and FDIC are not truth-seeking organizations. They are panic prevention agencies. We are in what they call an extended period of reassurance. Acknowledging an ongoing silent run would be an admission that their 2023 emergency interventions were a temporary bandage, not a cure. Their full-time job is to maintain confidence even as the data erodes it. History is the precedent. The savings and loan crisis of the 1980s festered for nearly a decade with minimal mainstream coverage, a nothing-to-see-here narrative until it exploded, costing taxpayers the equivalent of over $300 billion today. The real conversation is happening elsewhere. Find it in the deep-dive footnotes of analyst reports from boutiques like Autonomous Research, on blogs like the Lioness Report, and Calculated Risk, and in the chatter of institutional trading desks. The social proof is in the specialized forums, not the general headlines. They are discussing the mechanics of collapse while the public is told the patient is recovering. But this patient is headed for a final decisive surgery. The Fed's last buffer is about to be removed, forcing a brutal choice. Let me show you the $2.4 trillion countdown. The $940 billion didn't just go to a vague money market fund. It landed somewhere specific. Follow the digital trail, and you'll find the modern parallel. The shadow banking nexus of fintech apps, platforms like PayPal Savings, Wealthfront Cash, and Robinhood's Cash Sweep. They aren't banks. They are slick, user-friendly funnels that aggregate your cash and park it in staggering concentrations at a single, often obscure partner bank. This is where the 2023 risk has been repackaged and sold back to you as innovation. Let's analyze the similarity. Silicon Valley Bank's fatal flaw was deposit concentration, a massive pile of money from one interconnected tech-savvy community. Now, examine the partner bank behind your favorite fintech high-yield cash account. You'll likely find names like Green Dot Bank, Seller Bank, or Pathward. A single fintech platform can channel tens of billions of dollars into one of these institutions, creating a deposit concentration that makes SVB look diversified. The money is just as yield sensitive and just as digitally mobile, but here are the key terrifying differences. Velocity and psychological triggers. SVB's VC depositors talked on Signal and Twitter over a weekend. A fintech app, DAO-S users can be triggered by a single viral TikTok or a trending Reddit post alleging withdrawal delays. The 2023 run took 48 hours. A modern digital run on a fintech AES partner bank could achieve the same outflow in under 48 minutes. Opacity and complexity. You have no direct relationship with the partner bank. If it fails, you are a creditor of a fintech app you've never heard of, which is itself a creditor of a bank you didn't choose. The chain of accountability is a labyrinth designed to absolve responsibility. This demands a new risk assessment. The greatest threat is no longer just bank weakness, but systemic velocity enabled by digital aggregation. Your money could be frozen, not because your bank failed, but because an app 3 steps removed triggered a panic. Your monitoring metrics must evolve. FDIC's Problem Bank List, released quarterly with a lag. Cross-reference this with your fintech's disclosed banking partner. FHLB advances. Outstanding, a real-time weekly gauge of acute liquidity stress in the banking sector. A rising tide here is a red alert. Search alerts. Set up a Google alert for delayed withdrawals. $1, your fintech app's name. The silent run has entered its most dangerous phase, hiding in plain sight within the apps on your phone. The final catalyst will be the Fed pulling the last plug on the entire system, Garcia liquidity bathtub. Let S examine the $2.4 trillion reverse repo drain that will decide the timing of the next crisis. You are now part of the minority that reads the data, not the headlines. The $940 billion transfer is a completed fact. The institutional elite have already repositioned. This creates a simple but urgent divide. Are you with the crowd that acted on the information, or the crowd that's about to provide the next $940 billion? Take these 4 steps to secure your position. Step 1. The 30-second data verification. This is critical. Go to the Federal Reserve's website right now. Find the H8 release, Assets and Liabilities of Commercial Banks. Open it. Scroll to Table 2. Find the line item for other domestic banks. Look at the total deposits column from October to January. See the plummeting line with your own eyes. You have now bypassed every media filter and seen the primary source truth. Step 2. The strategic share. This information has a duty of care. Share this analysis with one person you know who has over $250,000 in any single bank account. They are the most exposed. Use this title, The 940B Signal Everyone Missed. You're not spreading fear. You're providing a lifeline of due diligence. Step 3. The community power play. Comment below right now. Post your bank's name and the APY they're currently offering on your savings. No specifics, just the numbers. Let us crowdsource a real-time map of which banks are paying for loyalty and which are taking your complacency for granted. This is collective intelligence in action. Step 4. The crucial serialization hook. Subscribe and hit the notification bell. This Thursday, I will publish the names, the 3 specific banks that lost the most deposits in this silent run, and the one single mega bank that absorbed over $400 billion of that fleeing capital. The winners and losers are already decided in the data. The results will shift your strategy completely. The final warning is this. In finance, silence is not peace. It is almost always the quiet, strategic movement of money by those with the best information, happening long before the public alarm sounds. The $940 billion is the definitive proof. Don't wait for the siren. By then, the doors are already closing. You have the data, the next move is yours.